Welcome to the channel. Today we're talking about how to keep a large down payment. Think $200,000 safe for an upcoming home purchase in the next 1 to 2 years. We will focus on capital preservation, liquidity, and simple, reliable options. First, we'll establish a key rule for short-term money. Next, we'll evaluate high-yield savings accounts, money market funds, short-term treasuries, and certificates of deposit. Then we'll walk through an example allocation and timeline. Finally, we'll cover practical tips and do a quick quiz so you can test your understanding. Here's the roadmap. First, the rule of thumb for short-term funds. Second, why prioritizing safety matters more than squeezing out a few extra basis points. Third, the safest parking spots for large cash balances. Fourth, a practical allocation example for $200,000 with a 1 to 2 year horizon. Fifth, operational tactics to avoid friction and risks. Lastly, a brief quiz to check comprehension. The central principle is straightforward. If you plan to use this money within 3 to 5 years, protect it from market volatility. That means the stock market is not the place for these funds. Instead, you should prioritize liquidity and safety. Suitable vehicles include high-yield savings accounts, government-focused money market funds, short-term treasury bills, and time-bound certificates of deposit if your timeline is fixed. If your horizon is longer than 5 years, diversified investments may be reasonable because you have time to recover from drawdowns. But for near-term purchases like a home, capital preservation is the priority. Safety first, because timing risk is real. Markets can fall sharply just before you need the funds, which can reduce your down payment and compromise your mortgage terms. You also require predictable access to cash, so liquidity is essential. With relatively attractive risk-free yields available, there is less reason to take risk with short-term goals. The opportunity cost of avoiding risky assets is far smaller than the potential loss from an untimely market decline. Overall, minimizing stress and uncertainty is worth more than a marginally higher yield. Let's outline the safest areas to park a large down payment. First, high-yield savings accounts at FDIC-insured banks offer simplicity and full liquidity, making them ideal for emergency access. Second, money market mutual funds that focus on government securities, as well as direct short-term treasury bills or short-duration treasury ETFs, provide exceptional security and often higher yields than standard savings accounts. Third, certificates of deposit can make sense when your timeline is fixed, such as exactly 12 months, because you can lock a rate and accept reduced liquidity in exchange for predictability. Together, these options prioritize safety and access over speculation. Comparing high-yield savings accounts to government money market funds and T-bills, the HYSA provides full liquidity at an FDIC-insured bank, subject to insurance limits per depositor, per bank, per ownership category. Rates are variable and can change at any time. It is ideal for your emergency buffer and immediate needs. Transfers usually take 1 to 2 business days. In contrast, government-focused money market funds and short-term treasuries are extremely safe because the underlying assets are backed by the U.S. government, though they are not FDIC-insured. These often provide competitive or higher yields, and liquidity is typically same day or T+1. They are held at a brokerage, so you should understand settlement mechanics and how to move funds back to your bank before closing. This table summarizes key attributes. High-yield savings accounts offer high liquidity, are FDIC-insured at the bank level, and have variable rates. They are best for instant access and simplicity. Government money market funds provide high liquidity, invest in government-backed assets, and benefit from SIPC protection for custody at the brokerage level, not for market value. Rates are variable. They are best when you want yield and strong safety. Treasury bills are obligations of the U.S. government. You can hold to maturity or sell earlier, and the rate is effectively locked if you hold to maturity. They suit a clear timeline. Certificates of deposit provide FDIC insurance for bank CDs up to coverage limits, but liquidity is low until maturity. They are best when your timeline is fixed and you can wait. Here is a practical example for $200,000. First, maintain a high-yield savings account for your immediate emergency buffer and near-term expenses you might face while shopping for a home. Second, place the core portion, for example around 60%, into a government money market fund or a short ladder of treasury bills to capture competitive yields with high safety. Third, if your closing date is highly predictable, consider allocating a small slice, say 10%, to a term-limited certificate of deposit to lock a slightly better rate. recognizing the reduced liquidity. Fourth, enable auto-roll features for Treasury bills when appropriate, and set calendar reminders around maturity dates to ensure funds are available when needed. Fifth, confirm FDIC coverage at banks, remembering limits are per depositor, per insured bank, per ownership category. At brokerages, SIPC protects custody if the brokerage fails, not market value. Sixth, keep taxes in mind. Bank interest is taxable at federal and state levels, while Treasury interest is typically exempt from state and local taxes. Finally, rehearse the transfer process back to your bank before closing to verify settlement times and cutoff hours so that funds arrive in time. This Gantt-style timeline maps a 24-month journey from sale to the next purchase. In the first 6 months, you establish accounts, fund the HYSA for immediate needs, and purchase the first set of T-bills or move assets into a government money market fund. From months 6 through 18, you maintain the latter or keep the money market fund position, reviewing yields and liquidity quarterly. In the final 6 months, you gradually unwind positions, allowing settlement time, and transfer funds back to the HYSA to prepare for closing. Checkpoints at months 6, 12, 18, and 22 ensure you verify liquidity and transfer mechanics ahead of the home purchase. From an operational standpoint, consider using more than one bank or brokerage to increase insured coverage and reduce bottlenecks. Confirm ACH and wire limits, along with daily cutoff times, before transferring large sums so you avoid delays. Prefer government-only money market funds rather than prime funds if your goal is maximum safety. Avoid reaching for yield with risky bonds, equities, or complex products, as these can introduce volatility at the worst time. Maintain thorough documentation, including statements, trade confirmations, and transfer records, because mortgage underwriters often request a clear paper trail of your funds. Quiz time. With a 1 to 2 year home buying horizon, which option best aligns with the goal of capital preservation and liquidity? Is it A, a broad stock index fund, B, a high-yield savings account at an FDIC-insured bank, C, a leveraged equity ETF, or D, cryptocurrency? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, the high-yield savings account at an FDIC-insured bank. It provides strong safety, full liquidity, and insurance protection at the bank level, which aligns perfectly with preserving a down payment that will be used soon. Second quiz. Which choice is not FDIC-insured, but is still considered very safe because the underlying assets are backed by the U.S. government? Is it A, short-term treasuries, or a treasury-only money market fund, B, a bank high-yield savings account, C, a corporate bond fund, or D, a prime money market fund with credit exposure? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, short-term treasuries, or a treasury-only money market fund. These are not FDIC-insured deposits, but they are backed by the U.S. government and are widely regarded as extremely safe for short-term capital preservation. The main points are simple. If your timeline is within 3 to 5 years, avoid market risk. Prioritize liquidity and safety rather than chasing a slightly higher return. The best tools for the job include high-yield savings accounts, government-focused money market funds, short-term treasuries, and time-bound certificates of deposit when your timing is fixed. Plan your timeline and test money movement prior to closing, and keep all documentation organized for underwriting. To wrap up, park your down payment in safe, liquid vehicles. Maintain an HYSA for immediate needs and use government money market funds or short-term treasuries for the core balance. Consider CDs only when your date is firm and you can sacrifice liquidity. Test transfers well before closing and understand limits and settlement times. Ultimately, the goal is to preserve every dollar so it is available when you find the right home. Please note, this content is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is unique. Before making decisions, consult a qualified professional who can evaluate your specific circumstances, including risk tolerance, tax considerations, and timing. Thanks for watching. If this was helpful, please like the video, share it with someone who is preparing to buy a home, and subscribe for more practical guides. I'd love to hear your approach. Tell us in the comments how you're parking your cash while you shop for your next place.